just to introduce myself, my name is Nick Secord, founder of Salon Numbers. Really work on helping you increase your profits, take deductions that end up having you decrease your taxes. So increase profits, decrease your taxes is something that we really focus on. So today we're going to talk about like travel is our motive, but we do have some more technical stuff as well that might to do with your business. And we're going to talk about 5 rules for tax deductible travel and some tax changes for mixed use of your home. So maybe you have a vacation property or you have something else like that. That's the kind of thing that we're going to want to talk about as well. And then we also have an update on 2022 for ERC for tax amendments and 2021 as well for the pandemic. So we're still not out of the pandemic regarding the IRS yet. For some individuals are fine. I just wanted to address what we've been seeing so far. All right. So disclaimer, right? The information contained in the presentation is for educational purposes only. Please consult your tax pro for additional information based on your individual facts and circumstances. Everything always needs to go, this stuff can be very technical at times. And we just want to make sure we're being compliant with all the tax laws, both in state and in the federal level. Generally here, I'm going to be talking about the federal level, 50 states, 50 different rules on the state level. So this is all going to be basically pertain to the IRS rules. All right. Did you know that only 57% of business owners plan to take a vacation? That hopefully is something that people want to try and reverse or add in, if you will, some trips, some family vacations, or some work-related vacations. And we'll talk about like the all or nothing rule here in just a minute. But look, if you can plan a really cool work trip to a vacation destination, let's see if we can write the whole thing off. Taking some mental health days. Sometimes you can really clear your mind about your business when you're out of the control of the business, when you're outside of the physical building, the salon, or kind of taking that break. You can kind of mentally relax and reset and maybe do some higher level thinking, and also get some additional write-offs that can help you have lower net income, higher deductions, while also being able to take personal benefit for those, again, for the purpose of the business travel. The tax law says there's no rule specifically on having luxury vacations. You can take a first class trip, on an airline. You can stay in the penthouse level suite at a hotel. You can go on a cruise. You can go on different places that would normally be efficient or could be a little bit more lavish in your travels, as long as you follow the rules to be able to get the full amount of the write-off. So let's talk about, let's kind of dig into that for a second. And really, we've got a couple of great articles that we have, and I'm kind of summarizing them here today. So if anything kind of triggers you, like, hey, what about this? Or, hey, I didn't think about that. Can I do this? You can always, ping me. We can have a quick call or talk about the ways you can maybe layer some of these deductions in and be able to take these fun vacations with work purpose and have them being written off. So the IRS kind of does a couple different things. Number one is these are kind of the bellwether things. These are not, I'm going to use the word bright line test. Essentially, if you can't satisfy these, we probably are in a gray area and you probably shouldn't write it off. If you can say, yep, I can confidently, I have records, I have notes, I have expenses, the purpose of the travel, we'll go through this here in a minute. Odds are, A, you can have the business write it off. B, you could take it, and C, it might actually benefit your business as well. Talk about strategy, learning technical skills, things that help you with a profit motive, and be able to kind of get out of town to kind of get away and continue to achieve your business goals, whatever those might be for you. So rule number one, overnight stay. So you get deductions for a trip in which you stay overnight. So if you are, let's say you live in Atlanta and you're going to be going to a conference in Atlanta, the actual travel part, you cannot write off. So you can't rent a hotel in Atlanta for your trip in Atlanta while you're in Atlanta for the conference in Atlanta. Why? Well, because the IRS says that you have to stay overnight away from your tax home. So that talks about it. Number one, staying overnight. We got that concept. You got to be, literally staying overnight somewhere else. Number two is tax home. So tax home, and I'm not trying not to get into the weeds with the technical definitions, but a tax home is anywhere within your local vicinity. So for instance, if I lived in a suburb of Atlanta and the conference is in Atlanta, I did not leave my tax home. Now, if I'm in Atlanta and the trip is in Jacksonville, right? Outside of your tax home, your local metro for your thing, that is going to satisfy being outside your tax home. You stayed overnight. That is kind of satisfying one of the rules here that we're going to want to kind of check that box and have written record, receipts, and why we're doing it. So that's first rule you're going to want to do. So if you're trying to like write off a vacation from yourself to yourself in your own town, that's going to be a problem right off the bat. Number two is profit motive. So the IRS doesn't really say in very clear language what would be, it has to be ordinary and necessary. It has to be something that would be normal and ordinary for your business. But they are very vague on those definitions. What I mean by that is there has to be a profit motive. For enable for you to write something off, it has to be for a profit motive. You can't be doing this for hobby. Hey, I fly airplane. I do remote control airplanes, and I want to write that off. No, that's a hobby. You have to have a business. It has to be attached to your business. It has to be for a business motive. That does not mean the profit has to turn tomorrow. You can't go to a seminar on a Thursday and say, I'm going to make more profit on Monday. We'd like that, right? To help recoup some of those costs, but it has to have an eventual profit motive for you and your business to be able to deduct it. What does that mean? Maybe I'll learn a new skill set that I can go back and work on. Maybe it's about building relationships and connections that I can eventually turn into profit, sales, receipts. You have to have that profit motive for the ventures. Again, it doesn't have to be immediate, but it has to be somewhere in the future where you can say, I did this and I was intending on spending that money because I'm trying to make a profit, and being able to articulate what that is, both now and in the future. There is international destination traveling for primary purpose, and there's domestic travel for primary purpose. And the IRS has just recently kind of expanded what they consider domestic travel. But basically, if you're going to go to France for your travel, there's a whole other set of rules with international travel and dates of stay and business purpose versus, or primary purpose on that international trip versus what it would be in domestic. But the primary purpose itself needs to still be there. So if you're traveling within the United States, the majority of the business days need to be travel. It's kind of an all or nothing test. You're either doing it for business or you're doing it for personal. So you can't say, hey, I was gone for 6 days. I went out to Yellowstone, right? I flew out to Yellowstone. I wanted to hike. I wanted to see the Grand Canyon and see some of the beautiful sights out in the West. We had a conference on Monday and I didn't come back till the following Friday because we're out sightseeing. Nope. The primary purpose was not specifically for your business purpose, for a primary purpose. Specifically, you have to make sure you can only write off the days where the whole intent of the trip was for business, number one. And number two, you spend a majority of the time doing the business purpose, the business days. So let's just say you did, let's say you go to New Orleans, right? And you're there for 2 days, but you fly out for 3. As long as there's a business purpose for why you're there the 3rd or the 4th or the 5th day, you're fine. But if it's no, I want to go tour New Orleans and see some of the cool, some of the cool swamp area or whatnot, bayous, you cannot use that as a write-off. All of those days and any expenses you have are non-deductible. You can't write them off because the primary purpose wasn't at that point for business. It wasn't a majority of the day for business. It was for personal. And you have to make sure the majority of the trip, your whole trip in totality, its primary purpose was for business. Rule number 4 here. Again, we're trying to check these things off, tick them off. And again, there's lots of literature on this. Just trying to get you to understand and kind of think, well, how could I take this trip I was going to plan? How can I either make one, or how can I make it to where it's more deductible, or make sure if I'm taking it, I'm kind of being gray on the rules. We're cleaning that up. We're being more compliant with what the IRS has for rules. So 4 only tests. So when planning a trip, ask yourself, does the trip make business sense? So again, we've got to be able to make sure it's a profit motive. We have to have the primary purpose be business. That being said, is the reason we're doing this for business, or is this really a vacation and we're going to try to throw something in? You can see how the only test would be for, is this a business trip for the purposes of duration, for the purposes of the purpose, as in I'm going there and I'm going to fly from here to Phoenix and I'm going to be learning these skill sets. I'm going to be hanging out with these business associates or these potential clients, or I'm going to learn this technical skill or these soft skills. There has to be a business sense in and around that trip. If you violate that, that nullifies really this whole entire concept of business purpose trip. That just was a personal vacation and you happen to do a tiny bit of work in the trip. Okay. So that's very important to know and to remind yourself of when you're thinking of, if I'm the IRS and I'm inspecting, why did you take that trip? What are your records? We want to make sure that it's only for the business. And then number 5, maintain records. So contemporaneous notes. So you're going to want to make sure that as you write down, here was a reason for my trip. Here's what we did on that day. This was a business day. This wasn't a personal day. I was there to learn these skill sets or meet these associates or learn this learn or understand this networking event, whatever it might be. Having those records in your business records for the purpose of the deduction. And again, we're going to talk about, so let's say your company has an accountable plan. An accountable plan is either part of a reimbursement plan, or if it's being paid directly by the company, having those contemporaneous records are very important for audits 3, 4, 5 years later, if it has to be, or if something comes up, you want to be able to say, this is my intention, this is how I executed it, and you can have those records in place, both the receipts and also the reasons and the purpose. Remember, I haven't sat here, show me your receipts, save your receipts. Yes, I'm not saying don't save your receipts. You know, you're staying at the hotel, you've got the airlines, you've got the rental cars. This whole thing has been about purpose, profit motives, days that you're doing business on the total trip. What is the purpose of the trip? So these are more noteworthy things that you need to have on record, more than, look, you can see my rental car receipt, right? That's not what we're talking about here. We're talking about more maintaining the records, the reasons why, so we're all staying compliant with the tax law. Hopefully that'll allow you to maybe take another trip, learn a new skill, do something to help your profit for your business, and have more fun along the way. So the kind of topic, we're going to stay on vacation. We're going to stay on vacation, right? We're going to get out of town. We're going to have fun. But this time we're going to kind of shift, instead of finding a new and exciting destination somewhere, let's talk about if you happen to have a secondary home, a vacation home, right? Whether it be a beach house or a house in the hills, or somewhere fun and exciting that you and maybe your family like to go to. There is a lot of what they call mixed use, or, hey, it's is this for a personal vacation, or is this something that the business can be written off for? How do I mix? How do I record? How do I keep track of a business trip at a secondary residence, or a personal home that is just a vacation home and we're going there for vacation? So we're kind of rolling a little bit what we talked about in the first topic, and kind of rolling into, what if I own the residence, and how can I make sure that we're deducting the right things and following the tax law, while simultaneously literally trying to make sure that we have not over deducted for things we might need to do. So with that in mind, let's talk a little bit about vacation rentals. Obviously, since the pandemic, there's been huge investments in investors doing Airbnbs and, portfolios of hotels that have been built and whatnot. But the market size and the value of vacation rentals is 100% going in the growth trajectory. As you can see by the graph, like it says, according to Grand View, vacation rentals will go from a $95 billion in 2024 to estimated almost $120 billion in 2030. So the concept of vacation rentals isn't going anywhere. It's only growing as people are shifting, retiring, they're wanting to get out and explore more and have a great time. So the size and the opportunity is there. So how do you maybe capture some of this, be part of having a vacation rental and use that, but make sure if there's any kind of rules around if it's an income producing property versus just a regular old vacation home that you and your family own. Let's talk about that a little bit more. So with that being said, some of the laws have changed. So I'm going to kind of go through these real quick. And again, I'm trying to stay high level, trying to get too much into the weeds because it can get real complicated quick, but know what a vacation home rule is, as in specifically number of rental days, number of personal days. If you're going to go ahead and rent it out like an Airbnb, do you have a short-term rental? Do you have a long-term rental? So you need to kind of know how your use and how that home falls into your particular usage. Again, that's what we talked about. Talk to your tax pro. There's very much specifics about days available, days for rental, if you're having a rental property and you use it for vacation, or if you just use a vacation without a rental property, or some sort of mixed use, right? The benefit of the Boynton-McKinney method, again, that's a kind of a technical tax law, but that basically goes into making sure that you are being able to deduct specifically what you can deduct and no more. Again, depending on how long your stay is, it might increase your allowable deductions for property taxes. If you remember, part of the Tax Cuts and Jobs Act limited your itemized Schedule A on your personal return, your ability to do property taxes to a $10,000 cap. Now, there has been some workarounds at the states from different things, but ultimately speaking, when it comes to vacation rentals, you've got a $10,000 a year cap on what you can write off for property taxes, and making sure you kind of carve that up correctly, again, based on usage. Usage has a lot to do with it. Just like what we talked about, vacations have to have a purpose, and what is a purpose behind the trip? Same thing here with vacation rentals, whether it be for income producing property or for your vacation purposes, making sure you're not trying to do more in the property tax write-off than you can legally. And then Rental demand, rental income may change its status. So depending on what is your rental income, depending on days of use, that can ultimately change whether or not and how much you can literally deduct, and if it becomes deductible or not. And then again, adding more. So because it's a ratio, the way that the Schedule E is the way the tax return is prepared on something like this, if you have a rental property, you're trying to make money, but you also want a vacation there a couple of days. By adding, just a kind of a tip here, by adding more rental days, really specifically short-term rental days, but long-term rentals would work as well, you're going to help shelter or be able to potentially increase some of your write-offs. Now, one big thing about this, people thinking, hey, I want to go out and get a vacation rental property, I want to get a vacation home, is if you're going to try to write some of it off, there's something called passive activity loss rule. So power rules, passive activity loss rules. And again, that's a whole other topic for a whole other day, but you really want to make sure that you're working closely with strategizing with your tax pro to make sure if you're going to be having that second residence, that vacation home, and you try to make it an income producing property, that we're understanding rules around exclusions and exceptions to the passive activity loss rules, where basically you can't have losses in your income, and just making sure you're optimizing them for your specific situation. Again, very complicated tax law, lots of things to check, a lot of boxes to check off and to tick off, and make sure you're taking full advantage of it if you do happen to have a second house and you're trying to find ways to get deductions or potentially even have it rented out. Now, there's also opportunities where you can also have off-site meetings as well, that maybe your business rents from your personal residence for a business purpose. Again, it goes back to profit and motive and days, and if there's a business reason for your rental from yourself to yourself from your vacation rental. So there's even more, again, it's kind of a second layer, kind of advanced layer of making sure we have deductions here that are following the IRS rules, but being able to generate lower your tax liability and legally pick up what you can for your property. About that, we talked about vacations, making sure you have the write-offs, make sure the purpose. We talked about if you have a vacation rental or if you have another property, how if we're using it for business, if we're trying to make motive, if we're taking their family vacation, how do we kind of read the law of the land and make sure you're being compliant, but being able to maybe pick up some more deductions, maybe some write-offs. And now we're going to get rid of the vacation. We're kind of off of vacation, and we're going to go all the way back momentarily, if you will, at least for the tax law when it comes to your 2020 ERC. So we're waiting for IRS guidance early on back in 2020, 2021 about this, but this is very clear at this point what the IRS guidance is. So let's talk about this again a little bit with your 2020 tax return, or your 2020 ERC, specifically if you have or have not received it yet, and what your accountant should have done since then about receiving that refund check of the payroll taxes paid and refunded. So specifically, this has to do with deadlines. So on May 24th, I think it's May 24th. Let me just check my notes here for a second. May 17th. On May 17th of 2024, so that actually was just over a month ago. Technically, the statute of limitations on amending your 2020 tax return, let's just say a business tax return or personal tax return, if it had a business on there and you were eligible and you did receive or applied for a refund from your payroll taxes for 2020, you would have needed to have already filed and reduced your write-off for payroll in the amount that you received or applied for the ERC credit. So you had payroll, you applied for ERC, the government has either sent you a check for that ERC for 2020, or you're still waiting on the IRS to process that amended 941 payroll tax return. And either way, per statute or guidance from the IRS, you had to have reduced those payroll wages out of your tax return. So let's just say you had $250,000 of ERC claims, whether you've gotten the $250,000 check plus interest from the IRS or not, you ultimately had to amend your 2020 tax return to disallow that $250,000 of a tax credit, that your refund check they gave you. You can't have written that off. So let's just say you did $1 million in sales and you had no profit. You made no profit in 2020. You had $1 million in sales, you had $1 million in expenses, and you had no profit. but you did apply for and get $250,000 of ERC for refunded payroll taxes for 2020. In your 2020 tax return, either originally or your accountant should have amended it for you by now. And again, the deadline, the statute of limitations for the 2020 amendment actually told out or timed out on May 17th of 2024, so just now. Or it could be the later if you're on extension, but we're going to leave that alone for a minute. You had to go back and basically on that $250,000, you had to disallow or write off or undeduct that $250,000. So as in this example, your original tax return would have said $1 million in revenue, $1 million in expense. You had no profit. But now because you got that ERC cash, you basically say, I've got $1 million in revenue, but I now have disallowed $250,000 in payroll deductions I took. And so now I would have a taxable net income of the $250,000. I would have gone from $0 in profit, added back the $250,000. So now I have a tax return from my business, whether it be on a Schedule C or an 1120S or a partnership return that says you now in 2020, because of the ERC refund or application of a refund, you now have a $250,000 tax liability. So you need to amend your personal return and make sure that everything's been filed and really paid at this point. So I'm assuming that that's been done for you with you and your accountant. You can always go back and check at this point to make sure that 2020, at this point, whether you've received the money or not, you still have applied for a refund. You still have the obligation to, or should have already, filed your 2020 amendments, paid the taxes due on your 2020 ERC, whether you received it or not, and been all compliant with the amending requirement for 2020 for your payroll, your business return and your personal return to file and pay, to unclaim the deduction because you got that. Now, let's roll this forward from 2020 into 2021. 2021, same story, the same thing. If you had an ERC that you're eligible for, you filed a return, you filed an amended 941X. It's sitting at the government, whether it received the check or didn't receive the check. You technically have to, because you have technically submitted a refund, the claim for a refund on overpaid payroll taxes. You have to make sure that your 2021 business tax return, or if it's on the Schedule C in your personal tax return, and your personal tax return for 2021, well, again, same thing. You had $250,000 you're eligible for, whether you received them or not from the IRS refund. You need to go ahead and file an amendment for 2021. You need to go ahead and pay those taxes or be on a payment plan with the IRS, because technically you have a responsibility to file an amendment and properly claim disallow or reverse that deduction for all those payroll taxes that you filed, that whether you've received a check from the IRS or not, you've already made a claim for refund. So you need to amend your 2021 business tax return. You need to amend your personal tax return and file and pay on that higher, the higher net income that you had that generated those higher profits, which would generally normally increase your tax bill. So make sure that now that right there, that has a 2025. So that's it's going to be 2 years from the date. The statute of limitations for 2021 has not run out yet. So if you haven't done the 2021, we still want to be able to do that so you are in compliance with the tax law regarding statute of limitations for when you can apply for an amendment on your tax return. Again, whether you receive the refund from the IRS or not, they actually have had a moratorium on processing ERC claims back in September of 2023. It was supposed to expire on December 31st of 2023. And now as we record this here, we're in June of 2024, and there are still definitely ERC claims that are in receipt at the IRS, but have not been processed, or at least checks have not been sent out. So there are more people who are maybe waiting for the 2021 refunds to show up in the 2020s, but the tax law is the same. If you're going to make a refund for claim for the ERC, you need to also make sure your income tax return for the business and personal is amended to reflect the fact that you've made a claim for refund for your payroll taxes. So this is big. This can result in a lot of penalties and interest if you're not applicable, if you don't comply with the law. So just make sure that you check with your tax provider, your tax pro, and make sure that you're in compliance on this. For that person. So I don't want to get, this is not about did I qualify or something. This is if you qualified, if you've claimed, you got to make sure that you've compiled it on the income tax side, not the payroll tax side. All right. Hopefully that was super informal. I know I try to keep things high level, fast, hopefully fun. I am an accountant though, so be careful. I can be dry sometimes. Ask my wife and kids. Anyways, and kind of that dad humor. But try to see if you need any other questions, you want to dig into any of these topics a little bit more, give myself a call or text or email or whatnot, and we'll be able to have a conversation and help you. Appreciate your time and attention. And doesn't look like we have any questions right now, so we should be good. Everyone have a great day, and we'll talk to you again soon.